Thank you so much for always stopping by. And please share this video to everyone that you know will benefit from it. And then and then if you have any question, just let me know. Or if you want me to create any video, just let me know in the comment section, and I'll always be there to attend to all your questions. So what are we doing today? So basically what we're doing today, we're looking at another financial analysis tool, a very, very important financial analysis tool that is used in most case studies, not all basically, but at least in most case study questions, that financial analysis tool is actually tested. Can you guess what it is? Well, let's dive into the video. All right, so we're going to be talking about net present value. That's what we're going to be talking about today. And net present value is a widely used or a common, very, very common financial analysis tool that is usually tested in a case study. So we're going to be talking about that today, and we're going to be dealing with that so that at least if you are faced with it in subsequent exams, you would at least know how to maneuver. All right, so first off, what is net present value? So net present value is a financial analysis tool that is used to assess the viability of a project or contract by comparing the present value of inflows with the present value of outflows. So basically, what are we doing net present? What are we using net present value for? Basically, what we're doing is I want to determine the present value of inflows and the present value of outflows. Now, why are we doing this? Now, look at an example. What is the sole aim of every business? The sole aim of every business is basically to make profits, right? So let's say you go into a business and then you have the cost, you incur cost of 15 naira, and then you incur inflow, or rather you achieve, or you get inflows in that sense, or revenue of 100 naira, and your cost, if your revenue is 100 naira and your cost is 15 naira, how much is your profit? 15 naira, right? 15 naira, that's your profit. So we can actually just say, okay, what's the cost of the project, what's the cost of the contract, and what is the inflow, what is the revenue per se of the contract, and get our profits. Easy, right? But we cannot do that in this case because most decisions that are being taken on contracts or projects are on projects or contracts that are going to be embarked on in the future. If they tell you something like, oh, the contract is going to be accepted or rejected today. Well, don't make decision on whether to accept the contract today, and today as well they are going to embark on the project today as well. Then we don't need net present value. What we will just do, what is the current cost, what is the current inflow, net it off, get our profits, easy peasy, right? But in this case now, most of the projects that we are considering in this case are future contracts, future projects. So that is the reason why we need net present value. That's the reason why we even need present value in the first place. If not, that is going to be a future project or contract, we'll just get the current value, right? So now, what is present value? Now we're saying that instead of using inflow and outflow, we're using the present value of inflow and present value of outflow. So what is the present value? What do you even mean by present value? Now let's look at that. Now, present value is the value of a future amount today. So now, like I said earlier, you want to embark on a project. Okay, this is 2024. Now, let's say you want to embark on a project in 2025. But then you want to make decision as to whether to embark on it now or not. The decision is going to be taken today in 2024. But we want to know what is the value of that cost or that project in that sense in 2025 today. So present value gives us the value of a future amount today in the present condition that we are, or present day that we are living in that sense. Now I give an example now. For instance, if you borrowed someone 1,000 naira 2 years ago, and the person used it to buy two loaves of bread rather, if he returns it to you today, you can barely buy one loaf of bread. Why? Because value of 100 naira, 1,000 naira rather, 2 years ago is higher than the value of 1,000 naira today. Now, I went to the supermarket and I discovered that I wanted to buy something, and the lady said the price was 1,000 naira, and I was like, oh, this thing I just bought it like 500 naira a few days ago, or like last week or so, and then you're telling me it's 1,000 naira today. I had to tell her, my sister, can you please confirm from your boss? And the boss was like, oh yeah, things have changed, Joe. It's now 1,000 naira. I was like, wow, okay, no problem. But then in that case now, that shows that the value of a particular amount of money today is much more than the value that it will be tomorrow. Why? Because inflation happens, economic realities, economic conditions happen. So this actually changes the value of money, or depreciates in that sense the value of money. And this is what we call the time value of money. So because of time value of money, because the value of money today will be different from the value of money in that 2025 when the project is going to be embarked on, we have to get in the present value. Okay, what is the present value? What's the value of that cost or that revenue in that 2025 today? So that when we're making our decisions, we're making our decisions based on realistic assumptions, and not just assumptions that would definitely change because of time value of money, inflation, and the likes. So now, with present value, we can actually determine the value of that 1,000 naira that was returned in 2 years' time. Yes. Okay, now in 2 years, 2 years' time, 2 years ago rather, the value of money that will be returned in 2 years' time. No, no, we borrowed somebody to 1,000 naira 2 years ago. So the value of that 1,000 naira in 2 years' time, we can get that's the future value, all right? And also the value of that 1,000 naira 2 years ago, we can get. I don't know if you get what I'm saying. So it's present value and future value, but in this case, we're not even dealing with future value, but with present value and future value. So now we have the future value. The future value is what 1,000 naira, but we want to get the present value because we're making the decision today. So present value helps us to get the value of a future amount today. The value of a future amount today. And I said, now, today now, of course, that 1,000 naira 2 years time, that's future value now. In that sense, that 1,000 naira that we'll have in 2 years time. Now we have this is 2024. So let's say that 1,000 naira that we'll have in 2026. Now we'll be like, you barely have the value of 500 naira. It will not even be worth 1,000 naira again because the value will have changed. The value will have reduced. The value will have depreciated because of inflation, time value of money, and economic realities. In that sense. So now, due to, like I said here, can you see there? Due to inflation, conditions, economic conditions, and all that. So we cannot make. So in summary, what are we trying to say? We cannot make decisions on as to whether to accept or reject a contract or proposal by looking at the absolute value of, or the current value in that sense, or the value that we know today for a product that I want to do in future. No, we cannot be using the total absolute value to make decisions. We have to discount it. We have to get the present value. How much is it worth today? So when we're making a decision, we'll be able to make the decision rightly in that sense. So now, what is the present value? Now, the present, let's now look into present value of inflows and present value of outflows. What MPV helps us to determine is basically the present value of inflows and outflows. Like I said earlier, if that we're taking the project today and we're deciding on the project today and we're starting the project today, we don't need present value. But because this project is a future project, I want to know the value of that future amount today. So that's the reason why we're actually doing net present value. So net present value helps us to get the present value of inflow and present value of outflow so that we can actually get. So it's when you get net present value, like now we said inflow minus outflow will give you profit. So net present value is sort of like saying present value of inflow minus present value of alpha will give us the net profit in that sense, or the net profit in the present state. I don't know if you get what I'm trying to say, right? I don't know if you get it. So to just give us the value today. So now look at this now. The present value of inflows is the total value that you receive in a future time. That's the total value that you receive in a future time. That's the present value of inflows. How much are you going to receive in a future time? So once you get the value of what we receive in a future time today, in the present day, okay, what is the value of that project? The inflows from that project. What is the inflows of that project that we embark on in a future time? What is the value today? What is the value today? Now, in that sense, so now what is the present value of outflows? The present value of outflows is the total value that you will spend in a future time today. Now, that value, now the total expense, cost, whatsoever that we're going to spend on that project in the future time when we actually really embark on it. What is the present value? What is the current value of that outflow today? So that's what present value of outflow is. So that's what we're just basically doing in next present value. Now let's now bring it to ICAN case study now. Your requirement two is usually your financial data analysis. So you'll be requested to assess a contract or a project in that sense. So when a company wants to embark on a project or contract, they will have to make estimates. Now, this estimate is what they will actually make, because now you're telling me that you want to embark on a project in year 2025. And you're telling me the cost is 5 naira, the cost is 10 naira. How do you know the cost is 5 naira or 10 naira? in that sense, because you're making estimates. Things may change. So now they will give you estimates of inflows, estimates of outflows for the project, right? So now you as a financial accountant, what you're going to do with that estimate there, we are going to have to get, okay, oh, this project, they said this project will cost 1 million naira and the inflows will be 2 million naira. Normally profit is supposed to be 1 million naira, because 2 million naira inflow minus 1 million naira cost will give you 1 million naira profit. But we cannot do it like that, because that's like a future amount. Things will change. Inflation will happen. That 1 million naira might not actually be that 1 million naira profit that we're thinking we'll get now. It not actually be 1 million naira in that sense. Things will change. The cost will increase. Things will change. Do you understand? So basically, we have to get the value today. That's just some simple thing of what we're just trying to say. However, we have to make decisions today and not in future. So we would like to determine the value today. That's why we need present value. So the reason why we are disturbing ourselves doing next present value in the first place is simply because we want to make the decision, we want to make a future decision today. A decision that will occur in the future. We want to make it today. So we have to get today's value, present value. Now, what is net present value? Like I said earlier. Now look at it from when you have terminologies of gross and net. In accounting, gross is like you have not deducted anything from it, but net is like you have deducted something from it. So when you have net present value, when you think of it from that aspect, just like you have gross profit and net profit. Now when you have net present value, it's just saying that we have removed outflows from inflows in that sense. We have just removed something. So it just trying to tell us that something has been subtracted from that present value. Now, what has been subtracted? Now, look at it here. We have the present value of inflows, you have it, minus the present value of outflows, will give you net present value. And your net present value can be negative or positive. Because if your inflow is less than your outflow, obviously, so if you have inflow, now you have 10 here, and here you're having 8. Obviously, you have 2 positive here, 2. But let's say you are reverse was the case. Now, in this case, you're having 8 here and you have 10 here. Obviously, you'll be having negative of 2. So your net present value may be negative or positive. So now, after determining the next present value is one that will help us to know whether to embark on the project or not. If we have positive net present value, that's like saying we have positive profits in that sense. Like you get, we have positive returns, we have positive inflows. We're going to yield positive returns. So in that sense, if I'm yielding positive returns, then the project is good, perfect, embark on it. But if we are going to be yielding negative returns, let's run away. Oh. So the next present value helps us, is the financial indicator of whether or not to accept a project or reject it. So that's what we're basically doing. So we'll have just done inflow minus outflow, but because it's a future decision we want to take, a decision that will occur in the future. So that's the reason why we're doing present value in the first place. So now we have annuity factor and discount factor. Annuity is when you have constant cash flows. You use this when you have constant cash flow. Like I said here, for instance, now if you're going to be receiving 1,000 naira annually for 10 years, that means you are going to be receiving constant cash flows. Now there's a formula that we can use. So I was saying that think of annuity like a shortcut or a cheat code. It's like a shortcut or a cheat code. So with annuity, we can easily get everything I want to get. We don't need to stress ourselves. We'll just say, okay, oh, there's a constant cash flow, so we'll just put it in the formula and get it straight up. Now, because instead of doing year 1,000 naira, year 2, 1,000 naira, year 3, 1,000 naira, we can just use annuity to get it once. So annuity is like a shortcut, it's like a cheat code that helps us to get our present value very, very fast. But then if it's that you are not having the same amounts, for instance, now you are having 1,000 in year 1, 2,000 in year 2, 3,000 in 4,000 rather in year 3, is different. It's not the same amount. You cannot be using annuity because that means you have to do it separately. So basically, annuity is like a shortcut that helps us. It's a formula that is like a shortcut, a cheat code formula in that sense that helps us to get our present value when we have the same cash flows every year. But if we don't have the same cash flows every year, then we're going to have to use our discount factor. Now, what is this annuity and discount factor? What is the purpose and everything? Basically, annuity and discount factor, they help us to get our present value. Like now, look at this now. We have our future cash flow times annuity factor. That's what that will help us to get our present value. If we have constant, don't forget, if you have constant cash flow, that means if you're getting the same amount of money, if you're, for instance, if your your revenue is 1,000 naira every year till the end of the project life or till a particular period of time, then you can use annuity. But if it's not the same, then you have to use discount factor. So present value with irregular cash flow is basically the future cash flow. That's the amount you're going to be getting in that project. That's future cash flow. Like I said, future cash flow is not, it's not necessarily inflow or outflow. It could be an inflow, it could be an outflow. But the future amounts in that sense, you're going to be time multiplying it with a discount factor if it is irregular. So what are the formulas now? Now look at the formula here. This is the formula for present value in this case. So you have your one all over 1 plus r raised to power n. This is also the same thing, right? This is also the same thing. This also can also be expressed as this. The annuity is 1 minus 1 plus r raised to power minus n all over r. And in this case, your r is your discount rate. So they will usually tell you the discount rate in the question. They'll usually tell you the discount rate in the question. And then the n is your number of years. That's the number of years or the project life in that sense. So this is the formula. So you use this when you have different irregular cash flows, while you use this when you have the same cash flow, constant, the same amount of money that is coming in or going out at a particular period of time, for like constant every year. But this is for irregular. So this is like a cheat code. This helps us to just do it fast, fast. So it can only be used only if you have constant cash flows. So what's now the format? How do you do it now? Now I was given a format, a suggested format. Now this is a suggested format I'm going to be showing you shortly. So it's not like, oh, you must follow this format. If you don't follow this format, you will fail. No, not at all. Oh. But then know that the year zero, in your year zero, I'm going to be showing you shortly. The year zero is your what? It's the beginning of the project. That's the cost you will incur the beginning of the project, that day you are starting the project. So that initial cost is usually your year zero. So year zero is like the day you are starting the project, the beginning of the project in that sense. So and then your outflows will be in brackets and your inflows will not be in brackets. That's what you should do. Your outflows should be in brackets, your inflows should not be in brackets. Now let's talk a little about working capital. Now, working capital is the amount of money that you use for your day-to-day running of the operation, like day-to-day. No working capital, they will say current assets minus current liabilities, the amount you use for the day-to-day running of the project or contract in that sense. So your working capital will be spent in year zero and recovered in the last year of the project. So your working capital, you have it in year zero because you are starting the project. I told you earlier that year zero is the year that you begin the project. So when you begin the project, you will incur working capital, you will incur costs for day-to-day operations. Cost for day-to-day operations, right? Now think of it like a bakery. In a bakery, they will definitely incur some cost every day for day-to-day operation. And when they start the baking business, the very first day they start, they will incur that cost that will be incurring every day, every day. And at the end of the project life, they will also recover that cost because they're in business to make profits, right? So in the course of the project or in the course of the contract, all those costs to be recovered because they will make profits basically. So they'll recover all those costs. So your working capital should be an outflow in year zero and an inflow at the last year. If it's 10 years that the project is lasting for, the working capital will be an inflow in that 10 years. If it is 2 years, it will be an inflow in that 2 years. Now, let me show you what I'm talking about here. Okay, before I show you, let me talk about scrap value a bit. Now, scrap value is the value that you use, the value of an asset after the life, after the useful life, or after the project life. Now, I was saying that think of it like a second-hand car, like a second-hand car. So after you have used the car, you have used the life of the car, the worth of that car. They'll tell you that okay, the brand new car is 6 million, but then the second hand is 1.5 million. That means wow, they have used the life of that car. In fact, the engine is almost as strong as it was when it was newly bought. So the value of that car now is 1.5 million. So that's like the scrap value. So at the end of the project life, all the assets they used, all the assets that was used during that period and all of that would be the value after. That's the scrap value. So now this is the format how it will look like. So you have your year. This, like I said, this is suggested format. It's not like, oh, you must do it. If you don't do it, you fail. Not at all. So you have your year. So this is your year zero. Remember I said that year zero is the beginning of the project year. So you have your initial cost, then discount factor, then your present value. Then year zero as well. Working capital will also be an outflow in year zero, like this. And you can see that in year two, in this case, the project lasted for 2 years. So in year two, working capital was an inflow. You can see it here. It was in brackets here and it was not in brackets here. So it's an outflow here and it's an inflow here. Then you have your inflows in that sense. So I just assume that in this case we had irregular out inflows in that sense, irregular inflows. So we just use our normal discount factor. But if it's like okay, the inflows were the same, we just have something like this. So you just have something like year one to year two in that sense. Then you have inflows, and then you have your annuity factor formula in this place. Then you have your answer here. So that's just basically how it should be. So you have your then when you net it off, this one will be minus in that sense. Minus this, you add everything, you remove it from your outflows, then you get your present value. And you know that your present value can either be positive or negative, and you make your decision. If it is positive, the project should be embarked on and should be accepted. If it is negative, the project should not be accepted. And if it is zero, then tell them that the company only will break even if this project is accepted or not. So they're the ones that will make the decision as to whether they want to do it or not. So basically, that's just basically all about net present value. I hope you learned a lot today. If you have any question, if you want me to explain anything further, if you had any confusion, if you want to have anything you want to just say at all, just let me know in the comment section, and I'll always be there to attend to all your questions. And if you want me to create any video, if you have a difficulty in a particular area and you would like me to create a video, just let me know in the comment section. And if you have not subscribed at this point, please don't forget to subscribe, share, like my video, and I'll see you in my next class. Bye.